Everyone, thanks for joining today. My name's Todd Davidson. I work here at the Energy Institute. I collaborate actually quite a bit with Gürcan and some of the other people in the room. I'm stepping in for Carrie and Fred and the rest of that crew that is normally here to support this effort. So to kind of kick it off, just a reminder of the next week's talk will be from Alan Lloyd. Alan is a research fellow at the Energy Institute. He's a former secretary of California's EPA, so their environmental protection agency essentially in the state. He was critical in establishing some of the emissions limits for transportation and establishing kind of basically the hydrogen system that is now operating there, sort of one of the first of its kind throughout the world for hydrogen fuel cell vehicles. He'll be talking to us about the role of science and technology in environmental policymaking. Today we have Gülen, who's a senior energy economist with the Bureau of Economic Geology here at UT Austin. He has 25 years experience working across the oil, natural gas, and electric power sectors. His current research covers assessment of domestic oil and gas resources, electric power dispatch modeling, global gas demand, US LNG exports, which is what he'll be touching on today, and supply chains of lithium and other critical minerals. He holds a PhD in economics from Boston College and a BA in economics from Bosphorus University. So I'm really excited to see this topic. It's kind of critical to what the flow of energy around the world. So with that, Gürcan, I'll leave it to you.
Thanks, Todd. So this is working, right? Okay, so let's get going here. Before I go into how many people know anything about the global LNG industry? Okay. Anything is a kind of a wide range of a question, but okay, so quite a few. So good. I have a lot of background slides that should bring you up to speed, the rest of you. So since I'm going to talk a lot about the global markets, it is important to understand how natural gas in general is traded globally, and either in the form of a pipeline or LNG. LNG is basically a form of transporting natural gas from point A, where it's being produced, to point B, where it will be consumed. Traditionally, we have done this with pipelines. Since the late 60s, 70s, we started liquefying natural gas by cooling it to a very cold temperature, and it becomes a liquid, and we can condense 600 times the volume to a tanker. Okay? That's the economics of LNG. But globally, and I'm going to talk about the US later. If you're familiar with the US natural gas markets, you may not know this. Globally, natural gas, historically, and even to this day, is primarily traded at prices that are indexed to the price of oil. Now, I'm talking about the natural gas value chain, but as you can see, my prices are $60 a barrel oil and $120 a barrel oil price. Okay? And that's because it's indexed to the price of oil or some oil product. The idea being, when this international trade started, natural gas was a substitute, and to this day, in many places, is still a substitute for oil products. It could be for fuel oil, residual oil for heating purposes, or power generation purposes, or industrial purposes. Okay? Now, what do I mean by value creation? It's being expensive and expensive. I like this. One letter change and it covers all the bases. What do I mean by expensive? Unlike oil, which is a liquid product, natural gas, as the name implies, is gaseous, right? It's a gas. It's not easy to carry a gas, put it in a bottle and take it home or take it to your car, right? It's not that easy. So that requires expensive infrastructure in pipelines, different diameter pipelines, metering at consumer sites, compressor stations to ship it longer distances, or if you need to liquefy it, expensive investment in liquefaction facilities, ships, and regas terminals. And I'll tell you a little bit more about that. So when that happens, let's start from the top. Distribution cost, this blue chunk is huge, because of what I just told you. In Austin, when you go home and if you have natural gas burning stoves or natural gas heat, how does that get to your house? Via an extensive network of pipelines. Small diameter, it's probably HDPE, high density polyethylene pipes that are connecting to your house. But even before that, they came to Austin city limits, and this is not the concert I'm talking about, it's the, the city limits for the gas utility, right? Via large diameter steel pipelines, special steel. Somebody invested in these infrastructure facilities and it's expensive. So those local distribution companies or local distribution utilities, or in short we call them LDCs, spend a lot of money to build, expand, maintain that infrastructure and serve the customers, reading their meters, sending them bills, collecting the bills, going after those who don't pay their bills and things like that, right? And this orange part, the distribution value, is really slim. Why is that? Because these are regulated businesses, because they are monopolies in their service territories. We cannot allow whoever your gas utility is in Austin to charge you whatever price they like, right? Because they are a monopoly, so their prices are regulated. So and this is globally the case as well, right? So when there's a sudden shift in the price of oil globally, again, that will impact the price of wholesale natural gas, the cost of wholesale natural gas, they may not be able to pass through that cost to their customers very quickly because the regulators has to approve that cost, okay? So this is something you need to understand, the expensive infrastructure, and it has to cover a wide area to connect as many customers as possible. This is important. This is why in many parts of the world, when oil and gas companies discover natural gas, they plug the well and abandon that resource if there is no nearby market. Because they're not going to spend money to develop an LDC network of pipelines and different customers. Okay? So this is a huge challenge for natural gas resources historically. LNG was one of the factors that simplified that, and the other solution has always been, and increasingly in the last 20 years, power generation. Everybody needs power. Everybody has a grid of sorts. In some parts of the world, they don't really work very well, but everybody has a grid. So if you discover a gas resource, you can build a gas-fired power plant, which will burn a lot of your natural gas, which may still be not enough to justify the investment in the upstream that you have to make to drill and develop that resource. So it has to be a lot of power generation. So these are some of the challenges that faces natural gas. On the upstream side, which is the E&P, exploration and production cost, and these are the taxes and royalties you pay to the resource owners, which is governments in many places, and then pipe it to the markets. So if the price goes up, the value is captured by the resource developer if they could get their resource to a market. Okay? So I spent a lot of time on this chart. It's conceptual. These numbers are not necessarily reflecting any particular country. It's kind of average if you want to think about it. Okay? But this is a couple of important concepts that I wanted to get across. Okay, some background on global LNG market. Their story is not really great. If you read it, you may get bored, but if you want to look at a lot of these fancy charts, International Gas Union every year publishes a World LNG report. It's a pretty good source for general data. They make some mistakes, but that's okay. In general, it will give you an idea. Okay, a couple of points here. Natural gas trade has been growing. So the red part is the pipeline trade. So these are international pipelines. And then the yellow portion is the LNG trade. Okay? What is the blue? Consume where produced. And that's what I mean. It's still mostly a domestic fuel. Okay? Again, because of all the challenges that I mentioned in the first slide, it is not easy to justify investment in expensive upstream infrastructure if you do not have a nearby market. And if you do not have a nearby market, it is even more expensive to invest in pipelines and LNG facilities to get your gas to a distant market. Okay? So that's the fundamental driver why, it's still a domestic fuel. And we're talking about large regions such as North America, right? And the pipelines. I mean, we have seen a significant LNG growth in the 2000s, but that growth has been kind of stunted since 2010. But the pipelines continue to grow in terms of amount of natural gas. And these are some numbers. I'm not necessarily going to read through those numbers, but you get the idea, right? Now, the picture has changed. Unfortunately, this data stops in 2015. Picture has changed in 2016 and 2017. LNG trade has increased significantly. Why do you think that is? What happened at the end of 2014, early 2015? No, it's not a US-specific issue. I emphasized the point in the first chart. Natural gas price is indexed to what? So what happened at the end of 2014? Oil price crashed. As a result, a lot of the LNG prices crashed, right? And on top of that, we ended up with a lot of excess LNG capacity around the world. So we have seen an increase in LNG exports. And I'll come back to that point later. This is just to give you an idea what's happening in the world. These are not all the trade routes, but these are the major ones as tracked by BP. Red ones are major pipelines, and the blue ones are LNG lines. Again, since pipeline is important, I just wanted to quickly give you a picture. Oil and Gas Journal every year publishes a pipeline survey that gives you numbers, the amount of pipelines of natural gas, petroleum products, and crude oil pipelines. So this includes all of them, but the great majority of all these pipelines that I will show you in the next several maps are natural gas pipelines. International Energy Agency 5-6 years ago put out a report calling it the golden age of natural gas. Well, it didn't turn out to be quite golden, but it's silver, maybe bronze or something like that. So we have seen a lot of natural gas activity, and you can see a lot of the activity is going to focus in all of these charts in Asia Pacific. A lot of the investment in the US and Canada is replacement of aging infrastructure, but also a lot of it is to connect new plays such as Marcellus, Barnett, Haynesville to consumption regions. And then the Asia Pacific is a growing market in terms of natural gas. So I'm going to quickly go through this, and later you can take a look at these numbers, or you can go to Oil and Gas Journal and find these. So there is a lot of activity. Okay? Now, coming back to LNG in specific terms. So throughout the 1990s, by the way, just a quick historical note, the first LNG trade 60s from Indonesia to Japan. Okay? Indonesia had a lot of natural gas. They didn't have the domestic market, and Indonesia is a country with many, many islands, so where the gas wasn't necessarily where their domestic demand would have been. So, and Japan needed to diversify their energy. If you know anything about Japan, it's an industrialized economy with no resources of its own. Nothing. No oil, no natural gas. Wind and solar are limited, so they are almost totally dependent on imported energy. And of course, after the oil shocks of the 1970s, they were always interested in diversifying their energy sources. So they have been a driver behind LNG. So, you know, that kind of sustained. I'll show you some other numbers later. It was a fairly dormant and small club, if you like, of LNG exporters and importers for a long time. That started to change in the 2000s. And these lines tell you the number of LNG exporting countries, the red line, and the number of LNG importing countries, the blue line. So today, as compared to maybe 20 years ago, where you had maybe less than 10 countries importing LNG, today we have countries that are capable of importing LNG. It doesn't mean that constantly import, but they are capable because they have the facilities, more than 35 countries, and more likely to be added to this list, and I'll tell you why in a bit. The other thing that you should note, the gray bar is the global regas capacity, which means these are the importing countries. They have to have a regasification terminal that can take the liquid natural gas, convert it back to a gas so it can be supplied to the domestic network, pipeline network, right? And the green is the total volume of LNG trade. So if you compare the gray and the green, what do you see? A lot of excess regas capacity, right? That's what I meant. Many countries may have these capacities. In 2015, China had 12 import terminals, 10 or 11 of them was mostly dormant. But after the oil price collapse, natural gas has become very cheap, LNG has become relatively cheap for them, and they're importing a lot, so they're using a lot more their regasification capacity. So this is capacity that is making it available to exporters, but actual utilization in many places will be very low. So these numbers, keep that in mind. It has been fairly stable since 2010, as I mentioned before, 225 to 250 million tons per annum. And that might be a weird unit for most of you, but that's what the LNG industry is used to. So let's do a quick math. 1 MTPA is equal to roughly 0.75 cubic meters. Well, actually, that's not 1 million, let me put it in million terms, 1 million ton is equivalent to 0.75 billion cubic feet, and then a cubic feet is 1 over 35.3 cubic meters, right? So make your translations, whatever number you like. Let's stick with the MTPA though. All of the charts are going to be in MTPA, mostly. Okay, so, and we have a lot more ships. When this trade started, in the 60s, 70s, these ships were even at that time were large ships. Today we have much larger ships. They have interesting names, Q-Flex, Q-Max. Q-Max were built for Qatari projects in the last 10 years. Well, 10 years ago, let me put it that way. But we'll talk about what you can do with those ships or not. And if you look at the numbers, these are the ships that are in service, that are put in service in each year. So red is the conventional ships. The purple, I don't know if you can really see the color differences. This thing sometimes works, sometimes doesn't. So, and if you look at in recent years, after the Qatari projects, we really didn't see too many Q-Flex or Q-Max ships. And there's a reason for that, and keep that in mind. We'll come back to that. But interestingly, we have some blues. What are those blues? Icebreakers. So some countries are developing LNG facilities, like Russia in their Arctic Circle region. So I guess they need these kind of facility, the boats. Okay, changing exporter mix. So this is the picture in 1995, mostly dominated by Indonesia. As I mentioned, this is the first LNG exporter to Japan and Malaysia, and then Algeria, North African country. Those are the really dominant ones, and a relatively small number. In 2016, this was the picture. First, there's a lot more countries exporting LNG. And what is the largest exporter? Qatar. Was Qatar here? Wasn't, right? So Qatar is a totally new player that came on stream basically 10, 15 years ago with very large projects. And the second largest is Australia. Australia is finishing a lot of new liquefaction facilities. In a few years, they may surpass Qatar in terms of the largest exporter. Of course, pending price competitiveness and things like that. So this picture changes. One thing to note, like what happened in countries like Indonesia and Malaysia, one, gas for LNG comes from their gas resources underground, right? And these are exhaustible resources. The fields deplete. So one thing happens is as the gas field depletes, the LNG facility can produce less and less LNG. And two, their domestic demand for natural gas increases, so they divert some of their exports to their domestic markets. So this happened to Indonesia and Malaysia in the past, and it has happened to Egypt recently. But now Egypt signed a deal apparently with Israel. Talk about interesting geopolitics. And Israel has some major discoveries offshore, and they don't have enough demand domestically. So they may send some of that gas to Egypt to be liquefied and sent to global markets. We'll see if that happens. Okay, so incremental stuff. I am always hesitant to put 1 year of data out there because we have a tendency as human beings to extrapolate very quickly, and we should not do that. But with that caveat, let me tell you, Australia is the one that really strikes us. That's because they finished a couple of major projects that came online, and as a result, from 2015 to 2016, we have seen a huge jump in LNG exports from Algeria. And the US, which will be kind of the second half of the talk, is the second largest incremental. Okay? Again, compare with this chart. Yes, Australia is big, but US is US even here? Yeah, it's basically only 1% of the global market, right? US is not a major exporter. Will it ever be? Okay, stay tuned. We're going to get there, hopefully. Okay, changing market shares of exporters. This is a dynamic picture, as I tried to mention. People change, the resources deplete, they divert cargoes to domestic markets. New resources are discovered, they are cheaper, and they need to be liquefied to monetize those resources, right? Qatar. Does anybody know where Qatar is? Yep. Right? Is there much demand in Qatar for natural gas, you think? I mean, it's a population of like what, few 100,000? That's about it, right? And they don't have a heating market, I would suspect. Right? And if you do not have a heating market, it's very difficult to create a natural gas pipeline network and large demand. And so power generation, fine, but 100,000 people, how much electricity are they going to need? So as a result, this was the only way to monetize those wonderful resources, right? So they built huge liquefaction facilities. So they became a major importer, but as you can see in the last few years, they start losing market share to Australia and few other countries. Now, US is yellow. Whoa, US has been exporting LNG. Did you know that? Since the 60s. Where was that from? From Alaska to Japan and other Asia-Pacific countries. We had a lot of gas in Alaska, and Alaska being very far away from the continental US, it made more sense to send LNG. And that probably required some special permits to send to a foreign country. Well, but that kind of disappeared 10 years ago. So where is the most recent yellow? I mean, if you have a good eyesight, you can see that little sliver up there. Okay, so kind of aggregate them rather than looking at it by country. If you look at by region, again, you can see the picture that Middle East, mostly dominated by Qatar, has been losing market share to Asia Pacific, which is basically Australia, but few others are also coming online. Malaysia and Indonesia are making new investments, and they may make a difference. Now, historically, the LNG industry talked about two basins, Atlantic Basin and the Pacific Basin. And the reason for that, the shipping economics did not really allow an Indonesian LNG tanker to travel either through the Suez Canal or around the Cape of Horn to European markets, right? So the Atlantic Basin consumers have been served by the Atlantic LNG exporters, Trinidad and Tobago and a few other countries like that in West Africa. And then the Pacific Basin countries have been served by the producers, the exporters in that part of the world. That has changed with these ships that I was telling you earlier. These Q-Max ships, now you can store a lot more LNG in it, so you reduce the unit cost of transportation. And now you could send them through the Suez Canal, although I got some mixed feedback on that, whether the Q-Max can actually pass through the Suez Canal fully loaded or not, but let's assume that it can. That, of course, shortens the distance to European markets, so it creates availability. So if you remember the BP map, you've seen a lot of blue arrows from the Middle East going either to the Asia-Pacific markets, Japan, South Korea, and others, as well as the European markets. Okay? And then Middle East, kind of a relatively late comer to the picture. They claim a big market share. And so the dominance of the Pacific Basin kind of trade has been waning, but it started to regain importance with the coming back of Australia in particular. Okay. Early days of the industry. Who imported LNG? Well, mostly is an Asia-Pacific picture, and mostly Japan, whoever said it. Later on, South Korea has become a significant importer as well, and nowadays, of course, China is also in the picture. So relatively a handful of countries. Today, as we already mentioned, 35 plus countries are capable of importing LNG, and this is kind of how they distribute. Japan still dominates, but only maybe 32%, whereas in the past it used to be 50-60% of the global LNG trade, right? So Japan is still important, South Korea is still important, China is growing in importance, but many others are coming into the picture. Now, who increased the most? Again, it's a one-year change data, don't extrapolate from this, but it shows what I said earlier, the drop in the global LNG prices, one, because of the falling oil price, and two, glut in liquefaction capacity in the world, allowed them to import relatively cheap natural gas, and wherever they could substitute oil or coal for natural gas, they did that. So China and India are the biggest jumps. Egypt used to be an exporter. Can become an exporter again, we'll see, but they actually imported a lot of LNG. So Brazil, what happened in Brazil? Well, Brazil had a good rainfall, so their hydro dams were full of water, so they could generate all the electricity they need from hydroelectricity, so they didn't need as much LNG, so they actually re-exported some of their cargoes they had agreements for. Okay? So you have to pay attention to these kind of weather patterns as well, what's happening. And I'll say one more thing about Japan. Japan dropped. Why? Because the Japanese LNG imports jumped significantly after a certain event. Fukushima, right? Well, they started to reopen some of their nuclear power plants. And as they do that, the demand for LNG started to go down, at least. This is what we're seeing in this year. There's a lot of uncertainty about what will happen with the rest of the nuclear power plants. And our colleagues in Japan cannot agree what's going to happen. So, kind of a summary, LNG trade is now more liquid. That's an economist term, meaning that there's a lot more players here. So more suppliers, more buyers. I haven't mentioned this before, but I'll talk about it in detail later. It's a technological evolution, if you like, that made it available to more countries. There's more ships available out of long-term contracts, and competition from alternatives. When I say alternatives, what we use natural gas for, let's say power generation. Here, alternatives could mean coal, nuclear, renewables, shale gas in places like the US, and I'll get that in detail later on. And domestic production in some places, either from conventional or unconventional resources. If natural gas production increases domestically, they won't need to import a lot more LNG. This is one thing that India would like to do actually, if they could get their fiscal regime in order. And then there's a lot more portfolio or trading companies, if you like, that buy and sell these available cargoes in the open market. That makes it a lot more flexible. The kind of in corollary, I say thanks to, but they kind of went hand in hand. So contracts are much shorter than it used to be. When Indonesia and Japan started this trade, their contract was about, I think, either 30 or 40 years. Take or pay. Take or pay means Japan had to take the cargoes or still pay Indonesia or the company that liquefied the gas for the volumes that they agreed upon. Okay? So now, the contracts are much shorter, and I'll show you some numbers how much shorter. And also, you don't have to take all the cargoes because there are now a lot more markets for LNG, so you can divert the cargo. This is known as the destination flexibility. And then less than 100% of the facilities are committed to long-term buyers. And I'll show you some of those numbers as well. The LNG export terminals that we have in the US, some of them have only about 50 or 60% of their volumes fully contracted by certain buyers. The rest are kind of available for speculative marketing. Okay? And then in some markets, they are shifting away from oil-based formulation of the price to gas-based pricing. Okay, so the share of short-term contracts. The definition of the short-term contracts, at least in this report, IGE report, is anything less than 5 years. So these blue bars that they call non-long-term trade are anything less than 5 years. So it could be very much of a spot cargo. You know, I decided today that there's a cold spell, I need more LNG, and I call them, and a ship turns around in the ocean and then comes to me tomorrow. Right? That kind of stuff, or 2, 3, 4 year type of contract. This is from a report that, you know, Andy Flower, who's a well-known global LNG expert, did for us last year, or maybe in 2016, I don't remember. This is from his report. So even only like 10, 12 years ago, average duration of a contract was 19 years. Nowadays, it's down to 6 years. So this is average, right? Some contracts could still be 10, 15 years, but some of them could be spot cargoes. No long term at all, right? When you average them out. So this is a significant change. But what you see here, it's kind of stunted in terms of the growth, right? Last few years, and now long-term trade has kind of been stable. And everyone doing it, right? So this is the number of countries importing, number of countries exporting, kind of these short-term contracts. And reexports. What are the reexports? So if you are a buyer of LNG with a long-term contract, but you decided that, you know, this week you don't need it, right? You sell it to somebody else in a secondary market. That's called a re-export. So that goes into that spot market, the non-long-term trade, right? So that kind of really peaked a few years ago. But again, something happened at the end of 2014 and, you know, early 2015. That market kind of died out. And what was that again? Collapse of the oil price, right? Well, now the oil price is down. My long-term contract that is indexed to the oil price is cheap enough. Why should I really buy for these re-exports? And probably the re-exporters could not discount the price enough to make it competitive with the oil index price, right? And the ships are available for speculative trading. And this is their term, which is apt, which means it's available for spot trading. These are new ship orders, right? Earlier I showed you the ships in service. These are the new ships orders. And you can see yellow part, the speculative part, is significant. And these are probably the portfolio companies, the trading companies that ordered these ships because they intend to use them speculatively to take advantage of arbitrage opportunities. Yes, Dave?
So
when the ship just is rerouted. Yeah.
And then on these new how long can they?
Well, these are ships, right? So if the ship is not full, if it's totally speculative, if it's not being utilized routinely, it doesn't have to sit anywhere full. So that's not going to lose any LNG. It may be used just, you know, when there's an arbitrage opportunity that the company wants to take advantage of. But you're right, you don't want to keep these things idle, full, because there is a loss of LNG. Again, remember, this is minus 260 degrees Fahrenheit. You cool these things. Yes, the tanks are sealed in these ships, but there's still, especially if you're in an area where the ambient temperatures are really hot, there will be loss, right? Evaporation. And actually, a lot of these ships, the modern ships, capture that evaporated LNG and use it as a fuel to, you know, move the ship.
So we hear the oil market.
Mm-hmm.
But you're saying here just because you can't really do that.
Correct. But you don't want to do that. The boil off is the term that he's using for evaporation. Yeah.
Professor, not thinking about
Okay, so the ships themselves, they're kind of gonna keep that temperature while they're in transfer, but regas facilities have these cryogenic tanks to store that LNG, and they're always in the cryogenic state, except for the maintenance periods. Then you empty one tank, you fill the next one, and you do the maintenance, and then you restart. I mean, natural gas market is a cyclical market. Within a day, across the seasons, so you're gonna need storage all forms anyway. And I'll get back to storage later. Okay, so increasing role of FSRUs. So Dave, maybe this will help. So FSRUs, floating storage and regasification units. These are increasingly custom built, but typically it's converted LNG ships. Okay? What they do is basically you don't have to build a regas terminal on shore. They are kind of parked offshore, and this is an offshore facility here. And when I say offshore, it doesn't have to be miles away from the shore, but it's offshore. So they are actually connected via these buoys and other infrastructure to underwater pipelines that bring natural gas. So they regasify the LNG on board and then ship it via pipelines as gas to the onshore system. This is helping a lot of countries become LNG importers, because this is a lot cheaper to do, a lot quicker to do than to build an onshore regas terminal with huge tanks and all the associated facilities, including the docking facilities for the ships. And you have to be in the right waterways to get the permits. It has to be deep enough and all of that. You need to have the pilot ships. You know, these things can get very expensive. As compared to that, this is a relatively cheap and quick option to become an LNG importer. Okay? So these things, again, do not keep LNG for a long time, but however long it may take to regasify while they're waiting. And these are relatively smaller ships, of course. I showed you 3 sizes. Typically, when they convert a ship, they convert the conventional size LNG ships to FSRUs. Now, finally, this gas-on-gas competition stuff, this is not happening in Asia-Pacific market yet, although there's a lot of discussion. Japan is trying to create an exchange. China is trying to create an exchange for LNG trading, so they can move away from oil indexation. In Europe, this is happening. This has been happening for some time. It's still, totally independent of oil price indexation, but the share of gas-on-gas competition in their LNG imports have increased significantly. Okay? Yes?
How realistic do you think it
So oil indexation, typical formula is, the price of LNG delivered is equal to alpha plus beta times the price of oil. Okay, so you can play with that alpha and beta. Beta is known as the slope term. And the reality is both the exporters and importers have renegotiated those terms over time. I mean, Japan did that as soon as the opportunity or the threat of entry from US LNG exporters came to play 5 years ago, let's say. Japan started going to Qatar, Australia, all their exporters, right? Well, I can get a cheaper LNG, from US or whatever, right? So that threat of entry allowed them to renegotiate some of those terms. And in the past, for other reasons, they've been able to do that. So, but from your perspective, I think those formulas are typically set such that the major producers and the developers of the liquefaction projects, they are not the one who were going to bear the risk.
Sure. So
No, it's not going away yet. It's going away in Europe, but not yet in Pacific Basin, because you have to have a liquid enough market. Okay, I guess this is a good point to talk about now the US. In the US natural gas market, have we ever had an indexation to oil for natural gas prices? No, we never did. Because we have a competitive market for natural gas. We have many, many producers producing from many, many different regions of the country, many, many consumers in different parts, residential, commercial, power plants, industrial, large industrial in the Gulf Coast and other places, huge pipeline networks. As a result, we never had the need to index by a formula the price of natural gas to the price of oil or fuel oil or anything else, right? So Henry Hub, you probably heard Henry Hub, that's the index that everybody uses. But of course, then we have basis differentials that will help you determine the prices at different parts of the country, depending on transportation bottlenecks, demand and supply, imbalances, and things like that, right? So in Europe, especially Western Europe, they're getting near to that stage, although the decline in the North Sea natural gas production is a problem for them. Without much domestic production, you're losing that competitive edge. But there are enough import terminals, and there are enough LNG exporters, and they're also getting some pipeline gas from North Africa, that they can create somewhat of a competitive market. That's what they're doing in gas on gas competition. In China, or in Japan, in South Korea, all of those things are lacking. No domestic production, not enough competitively priced import terminals, and these are not the same countries or like the European Union, members of a cohesive whole. You know, China and the rest of the countries in the region do not necessarily get along that well, right? So everybody's actually trying to position themselves. So Shanghai Exchange is trying to come up with an LNG contract. Japanese want to come up with their own contract, but it's slow going right now. So they are probably going to continue to be indexed to the oil prices for the foreseeable future. So I would be cautious saying that it's going away. Yes, a lot of people want it to go away on the consumption side, but it's not happening outside Western Europe. And of course, US, we don't even need to talk about US. Okay? Yes? Oh, really? Really? Okay, I'm going to go quickly then. So this is our estimates. This is a cost. Let me underline the name cost. These are not prices. So don't compare these things to prices of LNG. Okay, so, but for the US, rather than the cost of E&P, you have to look at the Henry Hub price. Because LNG exporters in the US have to depend on the natural gas market here. And for liquefaction, we have tolling arrangements. So the buyers of LNG from US terminals agreed to pay this price. So keep that in mind. It's becoming expensive. So US LNG story quickly. Okay, so not too long ago, National Petroleum Council 2017 study, this was their expectation. By 2030, we were going to import a lot of LNG. And with those expectations, we built 4 new import terminals, in addition to expanding capacity of existing terminals. And remember these names: Sabine Pass, Freeport, Cameron, Golden Pass. Okay, as late as 2008, a lot of import terminals were still being proposed to Federal Energy Regulatory Commission. And of course, 2008, to be fair, even Barnett didn't really peak in terms of its shale gas production. But of course, shale gas happened, and now we're talking about export. But there are still some interesting import terminals there, to note. Okay, did I mention the Sabine Pass? Sabine Pass is now approved as an export terminal. Well, of course, they had a lot of the storage facilities, docking terminals and stuff like that, so they had to invest in the liquefaction trains. Not cheap, still several $billion, but they called it an incremental investment. Okay, if you believe that, that's fine. Cameron, does it sound familiar? Where's the other one? Golden Pass, right? So all the terminals that we built, Freeport, to import LNG, they are now trying to become exporters of LNG. Okay, well, there's even more who doesn't have any kind of permits. So just to give you the picture, the blue bar, That's why I call this excitement in the US, right? There's a lot. Okay, so of course, I mean, there was some justification for that. So red line is Henry Hub price, which is the market price of natural gas. Once the shale revolution happened and the domestic demand for natural gas for power generation, petrochemicals, whatever uses that you can think of, wasn't enough, didn't increase fast enough to catch up with the increase in production capacity, right? And especially when we start drilling for liquids plays, Eagle Ford, Bakken, Permian, the associated gas production from these plays killed the price of natural gas even further. And so the dry gas producers in Haynesville, Barnett, Fayetteville, parts of Marcellus, they were not necessarily happy with that, but that's what they had to live with. But the end result, low Henry Hub prices as compared to prices globally, look, it's a huge gap. I mean, if you're a developer, you're going to look at that, hey, I can export LNG and make money. So the rationale is there. You can read this short piece where this chart is discussed in detail. So I have like several scenarios here. All the blue portions are the liquefaction, are the Henry Hub prices, $3 cases and the $4 cases. And then there's the liquefaction fee, which is the green, and then the shipping cost to different markets. Now, what you need to compare that with, well, after Fukushima, the Asia-Pacific prices were in $16, $17, $18 range. Well, of course, US LNG, even though in the most expensive scenario you can think of, you know, $7, $8, hey, it's great. It's very competitive, okay? Well, if you look at, though, Japan prices before Fukushima, that's dashed line here, and the prices in the national balancing point in UK, that kind of the range around that dashed line, let's say $10. Well, that still makes the US LNG look good, right? In most scenarios. But what happened to the LNG prices in recent years, of course, is it's $4, $5, $6. The Gorgon. Gorgon is the famous or infamous project of Chevron, Exxon, and Shell. All the big names are involved. Northwest Australia. This project was estimated to cost about $25 billion. Does anybody venture a guess for the final cost? 60. Let's agree on 60. We're not going to quibble about a few $1 billion, right? So for those guys, they know that under the current market conditions, they cannot recover any of their investment costs. Not very likely. But they will be happy if they can continue to operate and cover their operation costs and maybe service some of their debt, right? So that kind of, they came out with an announcement, or maybe not an announcement, maybe this is a secret conversation that I overheard, $4. No, I didn't hear anything like that, so it's just a number that was floating around, right? But this one, Gazprom, well, I can sell gas to Europe for $2. Whether they can, I'm not sure. I mean, they can certainly do it. Whether it will be high enough to recover their cost, that's a separate question. Because Russia has to develop new gas resources, probably in Siberia. Svetlana, correct me if I say anything incorrect. They're probably going to have to invest in pipeline networks too, to bring that gas, because their fields are depleting too. Their infrastructure is getting old too, right? But by the way, the pipeline exports to Europe from Russia has increased in recent years. And they are now also building a pipeline to China, right? Is that under construction? So, it's a bloody market out there. So that's what you need to think about. This $4 for Henry Hub, it was just a hypothetical scenario. Well, $4 is actually what probably a lot of the producers in Haynesville and Fayetteville would like to see to make their economics better, but they're not going to get it. Okay, so that's kind of the challenge for the US, and there's a bunch of other uncertainties, and this impacts not only US LNG exporters, but it will impact the Australian exporters or potential new project in East Africa. If you heard it, there are major discoveries offshore Mozambique and Tanzania. The only way to monetize those major resources is liquefy it and ship it to the global markets, because as you can imagine, Eastern Africa does not have big enough market to absorb all that gas, right? So it has to be exported. So all of these countries are going to face these challenges. Low natural gas demand growth. Okay, so this is why I was warning against extrapolating from 1 year of incremental demand data that I was showing you, China and India jump. I would encourage you to go find this short 200-page report that we released last year that looks into details the natural gas market conditions in China and India and some of the problems. Basically, they lack a lot of the natural gas infrastructure that I start with discussing, especially in India. Storage. One thing that makes the US natural gas market a very liquid, very competitive market, because we have a lot of large underground storage facilities, right? These are salt domes, depleted oil and gas reservoirs, and so on and so forth. These are very attractive facilities to have if you're going to have a liquid natural gas market. You could always have an LNG storage facility, but those things are expensive. So we'll see how much these countries can really increase their exports, especially if the oil price starts to increase, therefore the cost of LNG increases. In India in particular, but also in China, there is no market pricing or cost-reflective pricing of natural gas. They are mostly subsidized. And when they are subsidized, for example, upstream companies in India complain about these prices because they are not high enough for them to justify investing in their own upstream assets. They probably have some natural gas to develop, but they're not going to develop it especially for domestic market at the prices the Indian government wants to sell to their customers. For these countries, especially a country like China, and I think to a certain extent India and Japan, and maybe I'm an economist, that's my bias, energy security and cost is always going to trump any other consideration, period. They can talk the talk, but they will never walk the walk if it becomes too expensive to reduce emissions. Okay. Nope. I think, they can read the rest themselves. And this is just the one forecast number. Okay?
Excellent. Thank you, Gürcan. So we will open it up for some questions. We are recording the audio, so if you could please wait until we give you the mic so that anyone can hear what your question might be. Any questions?
They're speechless.
They've been asking their questions during, which is okay. Okay, so I have one. Maybe we'll just follow on some of the discussion that you had with regards to renewables and future demand growth, kind of playing some devil's advocate to, the potential growth or the golden age, as you said, of natural gas, which might have turned out more to be bronze, right? The question then for me is going forward, say 10 years, where are we going to be at? And I ask that because just recently, some of the market signals, you'll see one of the large offshore wind turbine facilities off of Scotland, basically the largest one in the world currently, hit a 65% capacity factor this winter. It's pretty incredible. And comparing that to kind of an average of, say, 25%, 30%. So people often argue we need natural gas because we need this, something that can kind of provide the reliable base load, sort of firm the grid. But so if we're seeing offshore wind that can do that, if we're seeing batteries that can potentially replace peakers, if we're seeing demand response and other forms of managing our energy, what do you think is happening globally, and will we really see, the projections on what you had for the FIDs, the investment decisions for LNG terminals and export, it was like 700 MTPA, right?
But that's the blue one, which is the pre-FID.
Right.
Those are all the speculative proposed projects in the U.S. because people are very excited about US LNG export. Those are not going to happen.
Well, agreed. But so even if a fraction of those happen, though, it seems like we're going to have a massive oversupply of LNG,
Okay, so
or at least export capacity.
again, I mean, if you're coming from the perspective of renewables, China has invested in wind and solar a lot. But again, they have a policy of reducing their coal. And they will have an all-of-the-above policy. They're also building about 25 nuclear power plants. So at the end of the day, for a country like China, it's always going to come down to energy security and lowest cost option. So if they're going to shut down coal plants as a base load, in most easy replacement in a short period of time is always going to be a gas-fired generation, which will also help them reduce their emissions, I guess, by at least 50%, right, if you're concerned about the GHG. So, renewables are always going to increase, but if you look at these numbers, the scales we're talking about, renewables and what the countries need, there's a huge gap. The time frame within which these countries are trying to meet their needs cannot be met by renewables. I mean, that's the way I see it. But that doesn't mean that China is going to stop investing in wind and solar. And it's just that, you have to look at it. 2 years ago, they were not importing this much LNG. Now they're importing this much LNG. So what do you think that LNG is substituting for? What is it replacing? Not wind or solar. It's replacing probably their coal generation, right? I mean, that in and of itself, to me, is a proof in the short to medium term, the price is always going to determine what these countries are going to do.
Questions? Yes, Svetlana.
Yes, continuing that discussion that you just had. So my question is, again, with regard to the China, if we do see that they work further towards introducing into the transportation sector more of the hybrids and electric vehicles, do you see a reappearing link between the gas and oil prices and supplies? Because now we're talking about substitution it on their transportation sector, not about the electricity or heating.
So China is also investing a lot in NGVs, especially in bus fleets and stuff like that. So they're also investing a lot in electric vehicles. Again, China has the all of the above policies, the mother of all of the above policies. And because as a, whatever you want to say, a centrally planned or centrally driven policy, very coordinated probably, they're going to be able to do this. I cannot imagine many other countries, let alone a place like India with multiplicity of voices, or a place like Europe or here, that I cannot imagine that kind of all of the above policy happening consistently any place else but China.
In the past, China's natural gas mix was about 5% of their energy mix, and they're going to increase to about 15 to 20%, so it's about 3 or 4 folds. Although it's still not large compared to North America, but for China alone, that is a huge, like you said, it's, it cannot have one type of fuel to do all the job, but natural gas is going to play a much more significant part, although renewables also will at the same time. So, yeah, that's a
I mean, maybe
great
I'm a
comment.
cynical person, but these kind of countries, you're in a globally competitive environment. They can talk about climate change, yes, we're going to do this. They can sign an agreement between Obama and Xi, right? But they want to be the superpower, or they want to be the most competitive, most powerful industrial economy. You cannot do that with renewables. They're going to diversify and they're going to reduce their cost, because without energy they cannot be competitive. I mean, if you see the world from those lenses, it becomes very difficult to imagine a world where, those countries can become competitive with wind and solar. Not with the current technologies. Yeah, if we have breakthroughs, that the solar panels becomes 75% efficient, and we have battery storage, and then we have no minerals problems, yeah, maybe, but that's not anytime soon.
I would argue as an economist that have a very different discount factor.
Of course.
So in the next 10, if there is a technology bottleneck right now. So China cannot do renewable all alone. China knows that, needs natural gas. And but anything after 2030, like what you're showing on the chart, that I think ultimately China wants to go to a low carbon and away from fossil fuel, but it also has a much different discount factor of looking at its long-term
I mean,
growth. So
I think, I'm not a risk management expert, but risk management, I was just listening to a podcast on the way over here. Does anybody listen to Interchange from Green Tech Media? They have some interesting podcasts. So they were talking to this guy who has written a book about solar industry. And this was like, from a risk management perspective, and just focusing on the solar technologies themselves, he was promoting, let's not just stick with this current solar PV technology, right? First of all, it's not a great technology, and we're investing a lot of money in this not so great technology. Let's spend a lot more R&D money on different solar technologies. And of course, if you aggregate that to a national scale, a country like China, India, or any country, the risk management perspective tells you, diversify your portfolio, invest in this, invest in this, invest in this, because you do not know which one is going to be the winner in 10 years, 15 years, 20 years down the road.
Yeah, and I want to kind of add one more sentence to what Gürcan just said about that, is let's not forget that China so far was supporting its renewables a lot through the subsidies. At the same time, it's been pouring a lot of money into developing its own shale resources, because as you talk about just CO2, then substituting coal with gas will already give you a big leverage on reducing emissions, which are much cheaper. You boost your economy with something that does not, hopefully will not require that much subsidies, because at least for shale, we already saw how it may boom. Whereas for renewables, we haven't seen much of the truly, economically renewables not supported with any kind of money from the governments, pretty much anywhere.
Both
Except
China
for maybe
and India, they cannot easily move away from coal either, because they have probably millions of people employed in the coal industry. They have a lot of coal mines. So they're going to have to find alternative jobs to those people if they decide to actually. We're living the same problem in the US, and we're trying to find solutions to that. If you go to West Virginia, West Virginia and Pennsylvania, they turn out to be lucky because Marcellus, the shale industry gave them alternative opportunities for some of these people. But if China cannot, and India, it cannot find, and they even said this very openly, they're politicians. They're not going to be able to, shut down their coal plants and coal mines unless they can find comparable employment to these people. I think there was a person who talked about India's coal policy a few weeks back in this seminar.
Last week.
Okay.
Time for one more question, one quick question.
So, Gürcan, thank you so much. We appreciate it. Great presentation. If you go back to that one chart that talked about the different price levels from, say, Russian gas and such not, just wanted to get a better understanding.
This one or this one?
I think this one, yeah. There's a lot of content there. It just seems like we would have the likelihood of many more billions of dollars spent on underutilized export facilities, just as we did with the import, because once they got developed or they were threatened to be developed, there'd be a competitive response by these other exporters that would just cut them off at the knees. Is that what you expect to happen, is just competitive response, and then it crowds out US LNG exports, and then we waste a bunch of money, or some investors waste a bunch of money sinking it in CapEx?
So what I typically and more generally puzzle about, not in China where the government has a policy, they give the money, so they build the solar manufacturing or whatever, coal plants, whatever, right? In a place like US, it's the private capital that is giving the money. So the developers are doing a great job of selling these projects. And we've seen this with the oil and gas drillers. We've seen this, we were talking about this before the session, right? We've seen this with the power plant developers. Some plants that should not have been built, they got built and they got financing. And we're seeing it probably with LNG facilities. And probably some wind and solar facilities. Somehow the money flows to these projects that, if a full-blown analysis were to be done, probably would be considered, too risky to undertake. That's kind of my high-level look at these things. I'm probably wrong about some of the industries at least, or some of the projects. So, but that's likely to happen for some of these facilities as well. But here the difference is these are tolling facilities, right? So, and 50, 60, 70% of their volumes are contracted out. So actually from a developer perspective, it may still be okay because they're going to get paid that $3 per MMBTU regardless of whether they're shipping any LNG cargoes or not. So the risk is actually by the companies who bought those. And actually, a lot of those companies are some of those re-exporters. Indian company Gale, who signed agreements with Sabine Pass, they were shopping around their cargoes because they didn't need it from the US. They had cheaper cargoes from elsewhere. Kogas from Korea, they did the same thing. BG, which is a portfolio trading company anyway, they didn't really have any destinations in mind. So that's kind of the deal. Maybe they're going to be okay because they have tolling agreements. But some of the other countries that build these facilities, you know, just to monetize the gas resource, and the companies who invested in them, you know, they may not be able to recover their cost and make a decent rate of return as high or as quickly as they hoped for. But, you know, that's the nature of these boom-bust industries.
Gürcan, thank you very much. Let's thank Gürcan for the excellent talk on LNG. So again, next week is Alan Lloyd talking about the role of science in environmental policymaking, so hopefully you can make it out for that. Thanks, everyone.